Hello students, and welcome to Topic 8 of Alternative and Renewable Energy Sources. The topic we will be covering is energy economics. Understanding economics as it relates to renewable energy is important. Whether or not the renewable energy systems is installed depends upon the simple payback and the internal rate of return on this investment. Therefore, we will need to be able to make these calculations and others. Some of the topics we will be covering are simple payback, time value of money, present value, net present value, discount rate, present value of annuities, and internal rate of return. We will be able to use Excel for many of these calculations. This is the simplest calculation, but it does not give a complete picture. Simple payback is the amount of time it takes to recover the initial investment calculated by dividing the initial investment by the annual cost savings. In this example, there is an initial cost of this project of $25,000. The annual savings as a result of the project is $2,500 per year. If we divide the $25,000 by the annual savings of $2,500 per year, we arrive at the simple payback of 10 years. As stated here, simple payback is easy to compute, but it does not take into account such factors as time value of money, inflation, project lifetime, or maintenance costs. Time value of money is its value, figuring, and giving amount of interest earned over a given amount of time. The basic premise is it is better off to receive money today than to receive the same amount of money in the future. Let's look at an example. If I had $100 today, invested it at an interest rate of 5%, I would have $105 at the end of a year from now. Therefore, considering a 5% interest rate, $100 invested today would have an equal value of $105 a year from now. This $100 invested today is at an interest rate of 5%, would have a future value of $105. Looking at this example in reverse would mean $105 a year from now would only have a present value of $100 considering a 5% interest or discount rate. This introduces present value of future money. As stated again, a given amount of money is worth more today because it can be invested. Future cash flows are normalized or discounted back to the present value. Present value is a method that allows for the evaluation of future income stream in such a way that is discounted back to its present value. When a number of values of a future income stream is lump sum, the sum is the net present value. As explained here, the net present value of a future stream of cash flows is dependent upon a specific interest or discount rate. The higher the interest or discount rate, the more the cash flows are discounted back to a net present value. The higher the interest rate or discount rate, the lower the net present value. Starting on this slide, we develop an equation for present value and future value. Using an interest rate of 5%, a present value of $100 would yield a future value of $105. Continuing on slide 12, we see that the future value is equal to the present value times the quantity, 1 plus the interest rate, to the nth power, where I is the interest rate and n is the number of years. We rearrange the formula to have an equation for the present value based on the future value and interest rate. In this example, we calculate that a little over $6,000 would need to be deposited in the bank, receiving an interest rate of 5% to have $10,000 in 10 years. Or we can look at it that $10,000 in 10 years at an interest rate of 5% would be discounted back to a present value of a little over $6,000. The net present value is simply the sum of all the individual cash flows or outflows discounted back to their present values. An example of net present value is given here. There's an initial $100,000 investment made. The results are inflows of case of $30,000 per year and outflows of $5,000 per year for a net annual cash flow of $25,000. Each of the $25,000 per year is discounted back to a present value for 6 years. The net present value is $8,881.52. Since the net present value is greater than zero, the corporation should invest in the project. The discount rate is different than the interest rate. Interest rate is a percentage rate of return on investment. Discount rates are set by the organization and is a function of investment risk return, alternative investment, cost of capital, etc. A high-efficiency furnace costs $2,000 more than a standard furnace. However, the high-efficiency furnace results in a $400 a year savings. With a 15-year life of the furnace and a discount rate of 5%, is this an acceptable investment? Present value of an annuity is used to calculate the net present value. The numbers are entered into the equation. The net present value is $2,151.86, which is greater than zero. Therefore, this is a good investment and should be accepted. The internal rate of return is the annualized effective compounded return rate that makes the net present value of all the cash flows equal zero. It is a discount rate at which the net present value is zero. This is the mathematical definition of internal rate of return. The next few slides gives us an example of the use of internal rate of return. We will look at investing thousands of dollars in the bank at an interest rate of 5% for 6 years. We will compare this to investing $1,000 into a piece of equipment and receiving $200 per year income. With the bank investment at the end of 6 years, we are able to draw out our $1,000 plus interest of $50. With the $1,000 investment in a piece of equipment, we receive $200 per year, and at the end of 6 years, the piece of equipment is worth nothing. This explains the investment in the equipment and the $200 per year return. The cash flow and the internal rate of return is shown for both cases. Excel was used to calculate the internal rate of return. With an Excel spreadsheet open, click on Financial, go down the drop-down box to IRR. Use that function to calculate the internal rate of return on each of the two cash flows. The interest rate on the bank investment was 5%. The interest rate on the piece of equipment was 5.47%. The machine investment is better. If there are any questions, please post them on the eLearn Help discussion.